Welcome to G Fun Facts Online. Think about your day so far. Did you buy a coffee, grab some groceries, pay for a subscription? If you did, you've likely paid a tax you might not even notice. Today, we're diving into the intricate world of consumption taxes, specifically the system that over 160 countries now use to fund their public services, the Goods and Services Tax, or GST. At its core, a consumption tax is levied on what you spend, as opposed to an income tax, which targets what you earn. The fundamental principle is that individuals are taxed on what they take out of the economy through consumption, rather than what they contribute through income and savings. Proponents argue this encourages saving and investment, which can lead to higher productivity and a better standard of living. While there are simpler forms, like a retail sales tax collected only at the final sale, or excise taxes on specific goods like fuel and tobacco, the international standard has become the GST, also known in many places as a value-added tax, or VAT. So let's break down how this sophisticated system actually works. The GST is built on a few core principles. It's multi-stage, it's destination-based, and it uses a clever mechanism called the input tax credit to prevent the cascading effect of tax on tax. Let's start with the multi-stage part. Unlike a retail tax paid once by the consumer, GST is collected at every single step of the supply chain, from the purchase of raw materials, to manufacturing, to warehousing, and all the way to the final sale. The tax is calculated on the value added at each stage. Let's use a simple example to make this clear. Imagine a furniture maker who buys wood for $100 and pays $10 in GST on that purchase. They then use their skill and tools to turn that wood into a table, adding a value of $150. They sell the finished table to a retail store for $250, plus $25 in GST. Now, does the furniture maker send that whole $25 to the government? No. This is where the magic of the input tax credit, or ITC, comes in. The maker gets to claim a credit for the $10 in GST they already paid on the wood, so they only remit the difference, which is $15, to the government. The retail store then does the same. They bought the table for $250, paying $25 in GST. They add their own value, let's say $50 for marketing and showroom space, and sell it to you, the final customer, for $300 plus $30 in GST. The retailer claims a credit for the $25 they paid and remits only $5 to the government. In the end, you, the consumer, have paid a total of $30 in tax, which is exactly 10% of the final $300 price. The government has collected $30 in total, piece by piece, from the manufacturer and the retailer. This ITC system is crucial. It ensures the tax is only on the final consumption price and creates a self-policing paper trail, as each business needs a valid invoice from its supplier to claim the credit. Another key feature is that GST is a destination-based tax. This means the tax revenue goes to the government of the place where the goods or services are consumed, not where they are produced. This is especially important in large federal countries. India, for example, has a dual GST model to manage this. For sales within a state, there's a central GST, or CGST, that goes to the national government, and a state GST, or SGST, that goes to the state government. For sales between states, a single integrated GST, or IGST, is charged, and the revenue is later apportioned between the central government and the destination state. This ensures a coordinated sharing of tax revenue across the country. Of course, not every country applies GST in the same way, especially when it comes to tax rates. New Zealand is often held up as the gold standard for a pure GST system. When they introduced it in 1986, they opted for a single rate with very few exemptions. Today, their rate is 15%, and it applies to almost everything, except for a few things like financial services. This simplicity makes the tax incredibly easy to administer and understand, leading to high compliance rates and generating significant revenue. In stark contrast is India's multi-tiered structure. India has several rate slabs: 0%, 5%, 12%, 18%, and 28%. Essential goods like basic food grains are nil rated, while luxury items and sin goods like tobacco attract the highest rates. The logic here is to reduce the regressive impact of the tax. Since lower-income households spend a larger share of their income on necessities, taxing those items at a lower rate makes the system more equitable. However, the trade-off is significant complexity, which can lead to classification disputes and administrative headaches. Canada offers another interesting model for a federal system. The national government introduced a GST in 1991, but some provinces chose to combine their own provincial sales taxes with it, creating a single harmonized sales tax, or HST. Other provinces kept their separate retail taxes. This shows that different systems can coexist, but it can create complexity for businesses operating across provincial lines. The implementation of GST has a profound impact on everyone. For consumers, the most immediate effect is on prices. While eliminating the tax on tax effect should theoretically lower prices, the transition period often sees a temporary spike in inflation as businesses adjust. But the biggest and most persistent debate is about regressivity. A flat tax on consumption is considered regressive because it takes a larger percentage of income from low-income individuals than from high-income ones. To counter this, governments use those multi-rate structures like India's, or they provide direct support. Canada, for example, gives refundable tax credits to low and middle-income families to offset the GST they pay. For businesses, GST is a double-edged sword. On one hand, there's the compliance burden. It requires meticulous record-keeping, regular filing of returns, and often investment in new accounting software. This can be especially tough for small and medium-sized enterprises. It can also create cash flow problems, as businesses have to pay GST on their inputs before they collect it from their sales. But the biggest advantage is the creation of a unified national market. By replacing a messy patchwork of state and central taxes, GST eliminates tax barriers at borders, allowing goods to move freely. This dramatically reduces logistics costs and delivery times, making businesses more competitive. GST also pushes the economy towards formalization. The input tax credit system incentivizes businesses to buy from registered suppliers, creating pressure for informal businesses to enter the tax net. From the government's perspective, a well-designed GST is a revenue workhorse. A broad base and high compliance can provide a stable and buoyant source of income. By bringing more of the economy into the tax net and curbing evasion through its self-policing mechanism, GST has the potential to significantly increase a country's tax-to-GDP ratio. Studies in countries like Pakistan and India have found a positive link between GST revenue growth and overall economic growth. Furthermore, GST can boost a country's exports. Under the system, exports are typically zero-rated. This means not only is no tax charged on the final export, but the exporter can also claim a full refund of all the GST they paid on their inputs. This ensures that taxes are not exported, making the country's goods more competitive in the global market. A modern GST system is entirely dependent on technology. It simply couldn't work without a robust IT backbone to manage the sheer volume of transactions. A prime example is India's Goods and Services Tax Network, or GSTN. It's a massive IT platform that manages the entire ecosystem, from taxpayer registration to the complex process of matching invoices for input tax credit claims. The next step in this technological evolution is e-invoicing, where invoices are reported to a central portal in real time, further increasing transparency and clamping down on fraud. Despite its many advantages, the GST journey is rarely smooth. Introducing such a sweeping reform often faces political resistance. In Canada, the GST's introduction was highly controversial and contributed to a change in government. More dramatically, Malaysia introduced GST in 2015, only to abolish it in 2018 due to public backlash, replacing it with a different system. This highlights how critical public education and political consensus are. Looking to the future, the world of consumption tax will continue to evolve. There's a growing push towards simplification, reducing the number of tax rates to ease compliance. The role of technology will only expand, with artificial intelligence and data analytics being used to detect fraud more effectively. And the biggest new frontier is the digital economy. Governments everywhere are grappling with how to effectively tax cross-border digital services and e-commerce giants in a fair and consistent way. In conclusion, the goods and services tax is much more than a line item on your receipt. It is a paradigm shift in taxation, a complex economic engine built on the principles of value addition and destination-based consumption. It offers a more efficient and transparent way to fund governments, create unified markets, and boost trade. However, it also forces societies to confront difficult questions about fairness, equity, and the administrative burden on small businesses. The global experiences with GST, from New Zealand to India, offer a rich tapestry of lessons. The ongoing debates and reforms show that the search for the perfect tax system, one that is both a robust source of revenue and a catalyst for economic growth, is a journey without a final destination. Thank you for tuning in to G Fun Facts Online.